Hello friends, namaste. Welcome all of you to my channel. Today let's discuss about how could we estimate the cash flow of the given project, and if we have a discount rate is given, then how we are going to find the net present value to evaluate the project whether this project is financially viable or not. So look at the question that I have taken from the Ross Stephen book titled Fundamentals of Corporate Finance 6th edition. You'll find it in page number 275 to 276, that is a discounted cash flow approach of valuation. In this question, suppose we believe that cash revenue from our fertilizer business will $20,000 per year, and assuming everything goes as expected and cash cost including the taxes is $14,000 per year, and we will wind down the business in 8 years. That is the life of this project is 8 years, and this project cost is the $30,000 to launch. That is a initial investment. We use the 15% discount rate, which is also known as the cost of capital. Now the question is about, is this a good investment? If there are 1,000 share of stock outstanding, what will be the effect on the price per share of taking this investment? Now once we read the question, then we organize the given information like this. Now let's move to the organizing all the given informations to estimate the cash flow part. Here altogether we have 8 years life of the project that you can see here, and the project initial investment is the 30,000, while 20,000 that you are expecting, that will generate 20,000 each year, okay? While cash cost is the operating cost is the 14,000 per year. So you would have a net flow would be simply, that is the inflow minus outflow, that is it will be 6,000, then just drag it, you will find your value. Now as per this given question, you are expected that 2,000 as a salvage value at the end of this project. So we have to add the salvage value at the end of 8 years to estimate the cash flow for the final year. I mean to say that is the 8,000, okay? That is the 2,000, and that is why you would have a cash flow would be here 6,000, because we don't have any value here. So 6,000, and again this for 7 year, and 8 year this will be 6,000 plus 2,000, that is the 8,000. Okay, now we simply estimate the cash flow for this project. Now to take decision whether this project is financially viable or not, then you are recommended to at least find the net present value, and that is nothing, that is the simply we can say that present value of future cash flow minus initial investment, okay? So look at the cash flow pattern. Up to 1 to 7 year we have a equal cash flow, so we can organize information like this. 1 to 7 year our cash flow is 6,000, okay, and this is not in thousand figure, okay? Then next one is that in 8 years we have that is the 8,000, okay? Now look at your present value interest factor. 1 to 7 is the annuity. So annuity is that PVI of K percentage n year. That is when you look at the present value interest factor annuity, PVI F is that is simply we can say here that is the 1 by 1 plus 0.15, that is a discount rate, whole to the power your life of the project is the 8. So this is 0.327, okay? This is the 8 year 0 PBIF. Now 1 to 7 is the annuity. So that is the present value interest factor annuity. This is simply 1 minus PBIF. That is simply what we do here. You can use annuity table or you can use the formula 1 minus PBIF whole to the power, that is the discount rate. Yeah, that's cost of capital. 4.487, okay? Now find the discounted cash flow, or you can say that present value, this into this. Okay, now simply this is also, yeah, if you click you'll get the same value, that is 8000 into 0.327. Now what about the sum? Sum is 29,538. Now initial investment we have, that is the launching cost is 30,000 given in the questions. So you would have a net present value would be simply total present value minus your initial investment. So you would have a 462 is our net present value. Okay, now number of share outstanding given in the question is the 1000. Okay, now what about the per share value? Then what I do here, this value divided by this. So you would have a negative value is here, that is the minus 0.62. Anyway, this project is not financially viable as we have a net present value is negative. Okay, I hope you understand, because you are going to find the, if your benefit is lower than that of cost, you are not going to accept the project. That is the basic reason. When I back to the questions, this is not a good investment as your net present value is negative, and next one is that even the per share value is also negative. As your NPV is negative, then obviously you would have a negative value. That's a 0. Per share negative value is the 0.462. Okay friends, whatever I discussed today, I believe that you could better conceptualize the term and you could apply in your business life, and including those students again who are struggling for the cash flow estimations and the evaluation, and I believe that today's discussion would be fruitful to them all of. Okay, if you like this content, please like, subscribe and also share this channel. Thank you all of you for watching this video. Please take care.